top 8 common investment mistakes. Investing successfully, defined as creating wealth over the long term through returns superior to no to low risk savings products, is something that has historically been possible for even small private investors. Despite their short-term ups and downs, major stock markets like London, Wall Street, and European centers like Frankfurt have always increased in value over the long term. A quick look at Yahoo or Google Finance data shows the average 20-year return from the Dow Jones Industrial Average is around 7%, rising to almost 11% over 30 years. In the UK, the FTSE 100 has returned around 4% a year over 20 years, and close to 7% over 30 years. By way of contrast, putting money in a savings account or investment-grade government bonds barely keeps the investor ahead of inflation. Currently, the best long-term easy-access savings account rate on offer in the UK is around 1.16%. So while investing might sound or seem complicated to new investors, the good news is that it doesn't need to be. For investors with a long-term outlook, solid returns are more than achievable. But investors do have to make sure they avoid making some common mistakes, which can undermine what should be a relatively uncomplicated long-term investment strategy. By simply not making these 8 common mistakes, you'll be well on your way to realizing worthwhile long-term returns on your investment portfolio. Investing before paying off high-interest debts. If you have debts like credit card balances, store cards, or short-term consumer loans with interest rates that run, as a rule of thumb, above 5%, pay those off before you start investing. If you don't, you may well lose more to interest due on the balances than you gain from investment returns. Investing money you can't afford. It's important to be disciplined about setting money aside to invest each month, but it's also important to only invest money you don't need to cover your living expenses. That will only either discourage you in the long term or see you build up debts that you'll then pay interest on. Not investing enough when you can. On the flip side of the coin, when you do have the resources, it makes sense to invest more. The earlier more money is invested, the greater the power of compound returns over future years. And it protects you from falling behind investment goals if the pendulum swings and you can't afford to invest as much during certain periods. Overtrading. Buying and selling shares costs money, so if you buy and sell regularly, returns will be eroded by transaction fees. Overtrading also often goes hand in hand with taking knee-jerk rather than long-term decisions. Buying when everyone else is. The best investment returns are usually made just after markets have had a downturn. Ironically, many investors buy more when markets are high. Don't try to time markets and invest regularly. But if you can, it makes more sense to buy more just after a crash or dip, not just before one. Blindly following tips on stocks and funds. Do your own research and keep it simple. Share tipping columns and media can be good for ideas, but blindly buying tips tends to be an express route to a poorly balanced and often unsuccessful portfolio. Paying too much in fees. Keep a close eye on the fees you are paying and keep them as low as possible. Actively managed funds that charge expensive fees can really erode returns over the years if they don't significantly outperform their benchmark index, which statistically they usually don't. Be very selective with actively managed funds you choose to invest in. Tracker funds are a good, cheap option, and you shouldn't go far wrong if these form the core and majority of your portfolio. Not diversifying enough. A well-diversified portfolio should reduce portfolio volatility, which boosts returns over the long term. Spread your investments across different companies, sectors, and geographies. For further details on the simple mistakes to avoid to give yourself the best chance of investment success over the long term, as well as other fundamental guidelines to keep you on the straight and narrow, download this complete guide to investing, available from our friends at ukinvestmentguides.com. Just click the link in the description below or visit www.ukinvestmentguides.com. If you liked this video and found the information helpful, please do subscribe to our channel by clicking this logo button here or the subscribe button below, as well as the little bell icon to ensure you never miss a video. We'll be covering many more useful topics, so stay tuned.